Hi, and welcome to the Grove Podcast video series. I'm Matt Battiali, your host. In these episodes, we try and bring you ideas and people and discussions that we at Mangrove Investor feel are important. These are parts of the investing and business world that maybe you don't see every day. So we try and highlight trends, strategies, and news stories that you need to pay attention to. So sit back, enjoy this episode, and thanks very much for watching. Hi, I'm Matt Battiali from Mangrove Investor, and today I want to talk to you guys about old school stock valuation methods. This is kind of important because this is how we tell, is a stock cheap or is it expensive? And one of the things I want to clear up right now, because this is a problem I run into a lot, is that the price of the stock does not mean a company is cheap or expensive. You need to understand that a stock price is a function of how many shares the company has out, and then what the price of the stock is. And if you multiply the number of shares by the price of the stock, you get what's called the market cap or the market value. And once we know that, then we can start to figure out what a company is worth and whether it's cheap or expensive. And that really comes down to how you want to measure it. And there are a lot of ways to figure that out. Most of them are old school, and I know some of you don't really care about old school finance, but we're going to do that now anyway. So let's start with what we call a price to earnings ratio. And basically this is for companies that have some sort of earnings, right? So they sell something and they get money in return. These are traditional businesses, and the price to earnings ratio is a fairly simple metric to figure out, but it's not the best metric, or it has some flaws, and we'll get into that. But so we measure price to earnings by dividing the current market value by a year's worth of earnings, and that's one of the first problems with it. It's looking backwards. So the result is basically a number that tells you how many years worth of earnings it would take to buy the company at its current share price. So you take the market value, divide it by 1 year of earnings, and you get what we call the PE ratio. And there are a lot of other variations to that. Sometimes some people like to add in debt and take out cash, which is called the enterprise value of the company. Some people don't want to use earnings, they want to use EBITDA. It's entirely up to you, and we can really get in the weeds with that. I'm not going to do that here. But I'm going to use a simple example. Let's say you want to buy a business like a car wash, and you want to use the PE ratio as a guideline for how much money to pay for the car wash. So let's say the car wash owns $10,000 per year in profit, and the owner wants to sell it to you for $1 million. We can figure out the price to earnings ratio on that by dividing $1 million, which is the price that he's selling it to us for, by the profit margin, which is $10,000. And what we get is that's 100 years worth of earnings for that car wash. I don't think that's a great deal. So if you don't want to pay that much, you don't want to pay that much for something like a car wash. I don't want to pay that much for a stock, because you just never make a profit on that. A more reasonable price to pay for a car wash would be 3 to 5 times earnings. For stocks, we can go into the 10 or 15 times earnings. But ideally, the lower the price to earnings ratio, the better deal you're going to get. I don't really rely on PE ratios to tell me when to buy a stock, but I use them to warn me of risk, right? The problems with PE ratios is they require companies to have earnings, and there are lots of excellent companies that have limited or no earnings, particularly in the tech companies. And there's an entire class of what we call new school companies that grow quickly with limited or no earnings. Think of companies like Amazon or Apple or Shopify. And while these companies start out that way, oftentimes they go way too far with them. They start out as a technology company like Amazon or Google, and then they move to sales, they have a revenue stream, and they still tend to trade for these crazy price to earnings ratios. And I just can't get this voice out of my head. I worked for a guy years ago who would absolutely destroy anyone who bought a stock that traded for more than 100 times earnings. He called it the honey club. And he had endless examples of companies that traded above that marker and then got completely destroyed. And I'm sure he's had a field day over the last few years because PE ratios went parabolic. Let me use Tesla as an example. Now, Tesla was a tech company when it started out. It pioneered, basically a new wave of vehicles. It was the electric car, there were smart cars, they're self-driving, and they really set a new standard. Today, every car maker out there has some version of an electric vehicle. But Tesla, in that process, kind of morphed from a tech company to a car maker. And many investors failed to recognize that shift, that they were no longer, the pie in the sky. Eventually, we're going to sell lots of vehicles. Now they're selling vehicles. And the price to earnings ratio got crazy. And if you didn't get out, if you didn't recognize this shift, you got clobbered. Back in October 2021, Tesla traded for about 368 times earnings. Yes, you heard that right. That's basically 368 years worth of that current earnings. It was crazy. And it meant that the stock priced in an enormous amount of success and left very little upside in that stock going forward, right? They're just like, how do you beat 368 years worth of earnings? So here's a chart of what the share price looked like as it went from a really good buy back in 2019 to a not so good buy at the beginning of 2022. Now, you wouldn't buy Tesla on a PE ratio. People who were investing in Tesla were telling themselves crazy fairy tales about how great this company was and what it was going to do for the world. If you bought it in 2019, it was a fantastic investment. That buying it in 2022 when it's trading over 300 times earnings, that works until it doesn't. And lately, it hasn't. Here's Tesla's chart today. Now, Tesla's high water mark was basically in November of 2021. Traded for $409 a share. Recently, its low was $113 per share. Now, that means the stock fell 72% in 14 months. That's a brutal loss. But, that's the risk you take when you buy these stocks that are trading for ridiculous price to earnings multiples. If you're willing to commit to a stock that's trading for 340 some odd years worth of earnings, you rolls the dice and takes your chances, right? So I still hear that voice in my head about the Honey Club. So no matter how much I love a stock, if it's trading for more than 100 years or 100 years of earnings, I have to pass. So I hope you enjoyed that video. Thanks very much for watching. I'm Matt Battiali from Mangrove Investor. And hey, if you liked the video, give me a like. If you didn't like the video, you have some comments, leave me a note. We're building this channel out, and I really would like to get some feedback from you guys on what you'd like to see going forward. I know many of you guys who watch this are still folks that used to watch me do gold mining stocks. So if you're interested in gold or you're interested in energy, drop me a line. Let me know what you want to see. Thanks again for watching. Bye. Well, look at that. You made it to the end. I hope you enjoyed the video, and if you did, give us a like and a subscribe. We'll make sure you keep getting great video content just like this. And thanks, as always, to Rob and Static in Verona for the music. I'm Matt Battiali for Mangrove Investor. Thanks for watching.